Hey guys, welcome back to my channel. It's me again, Money Mind. If you're new to this channel, please click that subscribe button and like one so that you can help this channel to grow. Before anything else, I would like to inform you that I'm not a financial advisor in securities. Therefore, my views and opinions on this video is only for educational and information purposes only. Warren Buffett's Berkshire Hathaway finally made a move this month with the purchase of Dominion Energy Incorporated's natural gas transmission and storage asset for a valuation of $9.7 billion, including the assumption of debt of $5.7 billion, therefore a cash consideration of $4 billion. This is expected to be closed at the fourth quarter of 2020, subject to the approval of regulators. Accordingly, Dominion Energy Incorporated wanted to reposition itself as a pure-play, state-regulated, sustainable, focused utility operations. They also have stopped the controversial Atlantic Coast gas pipeline along the U.S. East Coast, citing ongoing delays and increasing cost uncertainty in a separate statement per Bloomberg. Dominion Energy Chairman, President, and Chief Executive Officer Thomas A. Farrell said that the sale would allow them to increase their long-term earnings rate guidance by 30%, rebase their dividend policy to better reflect the revised operating and financial strengths aligned with industry's best practices. This could allow them also to increase their dividend policy swiftly than in the past. So what it means to investors then for us? Actually, this divestiture would mean that Berkshire will only acquire Dominion's gas transmission and storage asset, with Dominion retaining its interest to Cove Point. It will also retain its investments in renewable natural gas, which earnings will be reported under gas distribution segment results. Therefore, Warren Buffett's Berkshire Hathaway won't be having any significant influence on Dominion Energy Incorporated, nor will sit a board, nor will set the control of the management. Henceforth, investors should be aware that the buyer has no interest on Dominion's business. Hence, they must not be basing their investing decision on this move in according to Warren Buffett's influence or with regards to Berkshire to manage Dominion corporations. So what it takes to Dominion Energy Incorporated's financials then? The sale may result to a higher free cash flow while increasing debt leverage, as Berkshire will assume $5.7 billion of debt, as I mentioned earlier. It may result into a higher debt-to-equity ratio, which is a favorable one, and a higher current ratio. However, we need to consider the lost contribution margin to Dominion's income statement because on the effect of the sale. As we all know that this gas transmission and storage asset will be acquired 100% by Warren Buffett's company. Accordingly, the segment provides Dominion Energy Incorporated of 24% contribution on its operational earnings. That's almost a quarter from their 2019's operating revenue, or as much as $4 billion opportunity cost by 2021. Wow! Dominion just sold its unregulated business, which is now considered as the future of energy industry, as government and environmentalists is pushing away the use of fossil fuels. Likewise, investors are favoring companies with product and services favoring for our environment's welfare, such as of electric vehicle companies like Tesla and NIO shares, which had gone up today by 13.48% and 22.71% respectively, compared to S&P 500's 1.59%. As a result, the company reduced its dividend from 0.94 to 0.63 per share for the fourth quarter of 2020. Moreover, the company planned to having 2.5 per share dividend in 2021, which is according to them a 65% payout ratio to align with industry's best practices. But it will increase at 6% annually starting 2022 compared to previous long-term dividend per share growth guidance of 2.5%. It also revisited its operating earnings guidance, which is now expected at 3.37 to 3.63 per share compared to previous guidance of 4.25 to $4.6 per share. Even if with a buyback strategy, the company is reducing its dividend per share and earnings per share estimate. This move clearly suggests that they are now expecting lower revenue in the future as a result of that sale of their segment. Speaking of buyback, one of the purposes of this transaction is to purchase its common stock. Accordingly, $3 billion of the proceeds is allocated to common share repurchase, which will be effective immediately after the closing in late 2020. To date, Dominion Energy has total outstanding shares of 839.25 million at market value of 73.59 as of July 6, 2020. It potentially can buy back around 40.77 million shares. As a result, total outstanding shares shall be 798.48 million. This strategy could improve return on assets, return on equity, as well as earning per share, supposedly, if only there was no opportunity cost on the sale of its business segment. Using the growth rate of Yahoo Finance of 2.6% on the current year and 6.2% on the next year, let us find out the effect of this transaction to one of the best benchmarks in looking for a value stock. The company has $16.5 billion of revenue in 2019. Using the growth rate estimate of Yahoo Finance, 2.6% increase in 2020, revenue estimate must be $17 billion. Meanwhile, in 2021, before the sale, it must have $18 billion. But since it will be sold this year, then we have to reduce by 24%. Therefore, their total estimated revenue for this year, next year will be 13.7 billion, resulting into an operating margin of 16%. So let's go with our analysis on the impact of this buyout. First, we have to get the beginning balance of our assets for 2019 and then 2020 and 2021 as projected by me. So, the beginning balance is 103 billion. Cash proceeds on sale is 4 billion. Assets sold to Berkshire is worth 9.7 billion. Share repurchase is 3 billion. Projected income is 2 billion. So therefore, we have 97 billion of assets in 2020, while in 2021 is 97.8 billion, all things equal. I just considered the effect on the sale of the asset, its revenue, as well as on the balance sheet effect of this transaction. Liabilities at December 31, 2019 is 71.8 billion. Reduce that by a bailout by 5.7 billion, so it will become 66.1 billion in 2020. All things equal, 66.1 billion also in 2021. Stockholders' equity at the beginning of 2020 is 31.9 billion. Reduce that by a share repurchase by 3 billion and a net income of 2 billion. Therefore, stockholders' equity as adjusted in December 31, 2020 is 31 billion. Meanwhile, in December 21, it shall become 31.6 billion. Having that sales of 16.5 billion, 17 billion in 2020 as estimated, and 13.7 billion in 2021, they have a return on assets at 43% in 2019, 17% and 14% in 2020 and 2021 respectively. So it is a red flag to me because you are decreasing the return of that assets, which actually could provide a shareholder's value. Even on its return on equity at 64%, we are reducing it to 54% in 2020 and down to 44% in 2021, even if you're having a share repurchase. Meanwhile, profitability suggests that operating margin had decreased to 16% in 2021. The company might have a trouble in having a cash flow. So valuation of Dominion or ticker D, current PE ratio is 35.29, compared to S&P 500's 22.7. This is a red flag to me as well as their forward PE ratio of 15.93. Oh yeah, that's good compared to S&P 500 of 23.2. But on the revised APS, therefore their forward PE shall become 21.03, which is close enough, a borderline to S&P 500's 23.2. I have an intrinsic value for this company before margin of safety of 24.92 and after margin of safety by 15% of 21.18, which according to me, the stock is overvalued. Imagine a $25 intrinsic value compared to current price.
Bottom line, is the Dominion stock a buy?
Let's consider the following. At current growth rate, this stock is overvalued. With the elimination of a promising business segment, we can expect revision on growth estimates as well. The reduction of dividend payout seems not ideal for income investor either. Operating margin will decrease due to lost contribution margin being provided by gas transmission and storage assets. PE ratio is too high compared to S&P 500 as much as its forward PE based on revised estimates. I have the reason to believe that the stock is not discounted. Intrinsic value based on its free cash flow of $1,244,000 as a result of additional $1 billion from the buyout is below current share price. There is a risk that management would push the share price to the bottom so that it can buy as many shares as they can for the $3 billion allocation. As a result, your flexibility on your share liquidity is limited. Management and efficiency. Selling your promising assets in trade-off to focus on a regulated business, as a result, you lost a significant amount of operating contribution margin. To me, it just don't add up, as it clearly losing the value for stockholders' wealth. As heavily regulated the industry is, the company cannot increase its rates. Hence, growth will be limited. And for me, I will buy a company or shares of that company if its growth is reasonable. To be fair, the company's dividend plan or payout ratio, which will increase at a constant rate starting 2022, is good for income investor. It has a strong balance sheet with debt to equity an ideal of 2:1, which is very good one, and a liquidity ratio which is good for this kind of industry. It also has a high efficiency ratio, though it will decline because of that sale of that segment. To me, I cannot just purchase a stock having a limited growth, because one of my criteria to purchasing a share or to invest to something for a long-term basis is the company that could also provide me share appreciation along with dividend income. So that's all for today, guys. If you like this video, please click the subscribe button and help me this channel to grow by liking and commenting. See you next time. Bye-bye.